Investors fearing centralized banks have flocked to cryptocurrencies since the Great Recession. This growth has symptoms of a problem. Cryptocurrency's prominence has drawn financial institutions seeking bigger returns. Financial institutions rehypothecate using these coins as collateral. Cryptocurrency profits can be a gold mine, which attracts corporations to exchanges, but the hazards are typically neglected. Thus, cryptocurrencies have set the market up for the next recession by resembling the Great Recession. Before we move any further, subscribe to our channel. A government-backed cryptocurrency could stop the Bitcoin recession. It will be a stablecoin. Stablecoins are backed by assets or fiat currency. Government-held money and precious metals will support the stablecoin. This paper calls the stablecoin Dogecoin. Like other cryptocurrencies, Dogecoin will have comparable benefits. Stablecoins are safer and more helpful than regular coins. Dogecoin will allow cryptocurrency users to diversify their risk. A brief economic history. What caused the 1929 Great Depression and 2007 Great Recession? Shadow banks are rarely known, while commercial and investment banks are. Financial firms borrowing money from other financial firms called shadow banking. If the borrower defaults, the lender receives collateral. Commercial and investment banks employ shadow banks to retain liquidity or double their earnings by getting double the money for the same collateral. Consider Scott, a seaside house buyer. Scott mortgages this property and pledges his beach house as collateral. The Bank of Fordham, BOF, recognizes that their reserves are low and they could become illiquid if too many borrowers and mortgagors default. BOF requests a loan from Diller & Associates, DA, a larger bank, to solve this issue. Scott's beach house secures BOF's financing. DA lends BOF money since this home meets their needs. BOF can then decide whether to loan out the freshly acquired money and earn interest or retain it in their vault to maintain liquidity. Shadow banking is DA, BOF. The DA loans rehypothecation of Scott's home. Shadow banks favor information, insensitive collateral for rehypothecation because it is stable and always worth something. Great Depression causes were comparable. The government implemented bank run prevention laws after the Great Depression. The FDIC protected bank deposits and calmed laypeople. The Dodd-Frank Act of 2010 regulated banks in reaction to the Great Recession. Banks and their operations were regulated to prevent future panics from turning into recessions. Unlike the FDIC, this regulation did not control shadow banks, which caused the Great Recession. Shadow banking and rehypothecation with cryptocurrency collateral continue. Satoshi Nakamoto's Bitcoin white paper was inspired by the Great Recession and its aftermath. Nakamoto wanted to develop a new money system independent of banks and governments because he believed banks had failed investors. Instead, he intended his system to avoid centralized banking and shadow banks. Cryptocurrencies were initially promoted because miners and nodes were not centralized like banks. These nodes and miners were essentially networked PCs owned by people worldwide. Thus, Bitcoin was established to avoid institutions and give users financial control. Shadow bank cryptocurrency use will cause the next recession. Preventing cryptocurrency-induced banking runs. Investments and rehypothecation are vital to the economy. Investing accelerates money and advances technologies. Most financial institutions should rehypothecate collateral to maintain liquidity or boost yields. In his book, Slapped by the Invisible Hand, The Panic of 2007, renowned economist Gary B. Gorton suggests ways to avert future panics. First, Gorton proposes market transparency. Not knowing which banks were collapsing exacerbated the Great Recession and Great Depression. Transparency in the Bitcoin market should promote information symmetry and reduce dangerous or unneeded rehypothecation. Second, Gorton stresses system trust. Lack of trust in banks and markets caused the Great Recession and Great Depression. Gorton generalizes investor-bank confidence, but this study will divide it into internal and external confidence. Financial system internal confidence. Since banks regularly rehypothecate collateral and other financial institutions fund them in exchange for the collateral, financial institutions must be confident in their combined strength. External market confidence comes from common people. External confidence caused the Great Depression. Illiquidity may have been limited to a few banks if laypeople had more faith in the financial system. Due to FDIC insured deposits, the market grew steadily between panics and downturns. This improved external confidence because laypeople didn't have to worry about bankers' failed investments or loans wiping out their wealth. Given the recent Great Recession, consumers and investors may be wary of the market. Despite their volatility, cryptocurrencies are key market levers. Like the FDIC after the Great Depression, any remedy should restore market trust. Problem? Most individuals are apprehensive about cryptocurrencies and their valuation, making the market opaque and untrustworthy. Financial institutions also buy volatile and risky coins and rehypothecate them despite knowing the valuation is speculative and unbacked. This creates volatile valuations that could drop at any moment and provoke a bank run and another terrible recession or depression. Current cryptocurrency laws to ensure transparency and stability are ineffectual or inconsistently enforced. Cryptocurrencies have always been volatile. Figure 1 compares Bitcoin, Ethereum, and the US dollar index volatility, blue line. The U.S. dollar index converts a basket of foreign currencies into dollars. The monthly peak asset valuations from August 2015 to December 2019 were used to build the time series. Ethereum was volatile, but less than Bitcoin. However, the U.S. dollar index has been stable. The Bitcoin market is more volatile and information sensitive. Public opinion, artificial supply/demand, cryptocurrency competition, and coin utility heavily influence cryptocurrency valuation. The relative volatility of Bitcoin valuation weakens external and internal confidence in cryptocurrencies and market trends and suggests they could cause the next crisis. Cryptocurrency proponents argue that these tokens are information insensitive because to their bullish market despite severe volatility. Until a market panic or shock, these claims have not been adequately tested. The Ethereum 51% assault showed that a valuation drop might happen at any time. After the attack, Ethereum's value plunged as investors understood that attacks, while unlikely, were feasible and might cause huge losses. This reduces market trust when technology that seemed unassailable, like mortgage-backed securities, turns out to be defective and harmful. Due to their digital nature, Bitcoin valuation and profitability are theoretical. Since Satoshi Nakamoto owns more than 4% of all Bitcoin, cashing out his/their tokens can significantly affect Bitcoin's supply and demand. A recent study showed that one whale investor drives Bitcoin's valuation. Even if attacks on cryptocurrencies reduce or become obsolete, whales and secret actors in the market can still have strange and substantial impacts on value that harm external and internal confidence in the digital currency and establish their opacity. Solution? Ethereum Foundation researcher Vlad Zamfir suggests the government may build an alternative to popular cryptocurrencies. The US government should seriously explore developing a cryptocurrency. Government-backed cryptocurrency would stabilize cryptocurrency markets. Since the U.S. government and dollar are considered safe investments, this would boost Bitcoin investment confidence. Investors would be able and incentivized to trade their volatile cryptocurrencies for this new, government-issued, and insured coin in the event of a market shock. The government would operate this cryptocurrency, thus its specifications would be correct. As mentioned, modern cryptocurrencies hide numerous aspects and characteristics. The government might set a cap depending on their holdings and announce the number of coins they own, buy, and sell. Thus, a government-issued cryptocurrency would be more transparent and trustworthy than present cryptocurrencies. How will this prevent another bank run like the Great Depression and Great Recession? Dogecoins are less volatile than other cryptocurrencies. As mentioned, supply/demand, media opinion, and usage determine cryptocurrency valuation. Dogecoins will be capped at a certain number. The government will be clear about how its holdings affect supply and demand, and the currencies will be widely acknowledged due to official support. This controls coin volatility. This will boost external confidence and avoid investor panic from abrupt valuation shocks. This is it for today's video. Subscribe us before leaving. See you soon in another video.